Preparing for a Great-West Lifeco interview questions and answers interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What do you know about Great-West Lifeco? Great-West Lifeco is a diversified financial services organization focused on insurance, retirement, investment management, and wealth solutions. Its businesses operate across Canada, the United States, and Europe, serving individuals, employers, institutions, and advisors. I understand that major platforms include Canada Life and Empower, alongside investment management capabilities. What attracts me is the combination of long-duration customer relationships, recurring premiums and fees, disciplined risk management, and a clear purpose, helping clients achieve financial security through different market cycles. While answering, focus on Great-West Lifeco's diversified insurance, retirement, investment management, and wealth businesses, its international footprint, major operating companies, and how long-term financial security connects its business lines. Question 2. Why do you want to work at Great-West Lifeco? I want to join Great-West Lifeco because its work has a tangible impact on people's financial security, from retirement income to protection against unexpected events. I am also attracted to the company's scale and diversified platforms, which would let me learn across insurance, investments, and financial reporting. My background in analysis, control, and stakeholder communication fits an environment where accuracy matters. I would value contributing to a respected organization while developing a long-term career in financial services. Make sure to cover the company's purpose, scale, reputation, learning opportunities, and relevance to your skills. Connect your motivation to insurance, retirement security, client outcomes, and responsible long-term financial management. Question 3. How does an insurance company make money? An insurer earns premiums or policy fees, invests available capital and policyholder funds, and pays claims and benefits when contractual events occur. Profit comes from managing underwriting risk, investment returns, expenses, and fees effectively. For example, life insurers earn investment income on assets supporting long-duration liabilities, while retirement businesses may generate administration and asset-based fees. The key is not simply collecting premiums. It is pricing risk accurately, reserving adequately, and investing prudently against expected obligations. In your answer, talk about premiums, investment income, fees, claims, expenses, reserves, underwriting results, spread income, and the importance of matching assets with liabilities over the policy life. Question 4. What is International Financial Reporting Standard 17, and why is it important for Great-West Lifeco? International Financial Reporting Standard 17 is the accounting standard for insurance contracts, designed to improve consistency and transparency in measuring insurance liabilities and recognizing profit. It generally uses discounted cash flows, a risk adjustment, and a contractual service margin representing unearned profit. That margin is released as services are provided, rather than recognizing expected profit immediately. For Great-West Lifeco, implementation affects reporting, systems, actuarial models, controls, and performance analysis across products, so accounting and business teams must work closely. Be sure to mention International Financial Reporting Standards 17's measurement models, contractual service margin, risk adjustment, discounting, insurance revenue, profit emergence, comparability, and the operational importance of data and controls. Question 5. What is the contractual service margin under International Financial Reporting Standards 17? The contractual service margin, or CSM, represents the unearned profit in a group of insurance contracts. At initial recognition, it prevents profitable business from creating an immediate gain. Instead, the CSM is released systematically as insurance services are provided, usually using coverage units. Changes relating to future service may adjust the CSM, while losses on onerous groups are recognized immediately. Therefore, CSM balances provide insight into future profit emergence, though they require careful actuarial and accounting interpretation. Focus on the CSM as unearned profit, its initial calculation, release for insurance services, treatment of onerous groups, experience changes, and its relationship with future profitability and earnings emergence. Question 6. How would rising interest rates affect a life insurer? Rising interest rates can have mixed effects. Higher rates may reduce the present value of long-duration insurance liabilities and improve future reinvestment yields. However, existing bonds can decline in market value, creating losses depending on classification and hedging, while policyholder behavior and guarantees may change. The net result depends on asset-liability duration matching, product design, and accounting presentation. I would analyze economic value, reported earnings, solvency capital, and liquidity separately before concluding whether the impact is favorable. In your answer, distinguish asset and liability impacts, duration matching, reinvestment income, discount rates, unrealized gains or losses, product guarantees, capital, and the need to analyze both short-term and long-term effects. Question 7. What is asset liability management in an insurance company? Asset liability management aligns the insurer's investments with the timing, amount, currency, and risk characteristics of policyholder obligations. I would examine duration, convexity, expected benefit payments, liquidity needs, inflation exposure, credit quality, and policyholder behavior. The objective is not simply to maximize portfolio return, it is to earn an appropriate risk-adjusted return while preserving the ability to meet claims. Strong AUM reduces earnings volatility, protects solvency, and supports confidence in long-term guarantees. Make sure to cover duration, cash flow matching, interest rate sensitivity, liquidity, credit risk, policyholder behavior, hedging, capital requirements, and how investment decisions support promised benefits rather than maximize standalone returns. Question 8. How would you evaluate an investment portfolio for an insurance company? I would evaluate the portfolio against both return objectives and liability needs. First, I would compare duration and cash flows with projected benefits, then assess credit quality, concentration, liquidity, currency, and interest rate sensitivity. I would review expected yield after defaults, fees, and hedging costs, alongside regulatory capital consumption. Finally, I would run stress scenarios for spread widening, rates, equity markets, and defaults. A portfolio is attractive only when its risk-adjusted return remains appropriate relative to the insurer's obligations. Be sure to mention yield, duration matching, credit quality, liquidity, concentration, regulatory capital, impairment risk, diversification, scenario analysis, and whether returns adequately compensate for risks and policyholder obligations. Question 9. What is the difference between insurance risk and market risk? Insurance risk arises when actual claims, mortality, morbidity, lapses, expenses, or policyholder behavior differ from assumptions. Market risk comes from movements in interest rates, equities, currencies, credit spreads, or other asset prices. For example, higher mortality affects protection products, while falling equity markets affect investment portfolios. Insurers manage these risks differently. Underwriting and reinsurance address insurance exposure, while diversification, duration management, derivatives, and capital buffers address market exposure. Both ultimately influence earnings and solvency. In your answer, distinguish underwriting and policyholder risks from investment price risks. Provide examples, explain measurement approaches, and show how diversification, pricing, reinsurance, hedging, and capital management address each category. Question 10. What is reinsurance, and why would Great-West Lifeco use it? Reinsurance is an arrangement where an insurer transfers part of its risk and premiums to another insurer. Great-West Lifeco could use it to reduce concentration, protect against severe claims, manage capital, support new business, or stabilize earnings. A quota share arrangement transfers a percentage of premiums and claims, while excessive loss coverage responds above a defined threshold. I would also consider cost, counterparty credit risk, contract terms, collateral, and residual obligations, because reinsurance reduces exposure but does not remove accountability to policyholders. Focus on risk transfer, capital relief, catastrophe protection, earning stability, quota share and excessive loss structures, counterparty risk, pricing, and the fact that reinsurance does not eliminate the insurer's customer obligations. Question 11. How do insurance reserves differ from provisions in general accounting? Insurance reserves represent the estimated present value of future benefits, claims, expenses, and related cash flows arising from insurance contracts. They are highly dependent on actuarial assumptions such as mortality, morbidity, lapses, expenses, interest rates, and policyholder behavior. A general accounting provision may cover a broad uncertain obligation, but insurance reserves are often longer-term, model-driven, and linked directly to contractual service. I would emphasize governance, assumption documentation, model validation, and regular comparison of actual experience with expected results. Make sure to explain reserves as estimates of future policy benefits and related obligations, the role of actuarial assumptions in discounting, uncertainty, experience updates, and differences from ordinary expense provisions. Question 12. What financial metrics would you monitor at Great-West Lifeco? I would monitor earnings and operating performance, but interpret them through the business model. Relevant indicators include insurance revenue, new business sales, fee income, assets under management, net flows, expense efficiency, persistency, claims experience, CSM movement, and return measures. I would also track capital ratios, liquidity, investment performance, and sensitivity to market movements. The quality of growth matters. Increasing sales is valuable only if pricing, retention, capital consumption, and long-term profitability remain attractive. In your answer, cover earnings, operating return measures, sales, premiums, fee income, assets under management, capital ratios, CSM trends, expense efficiency, persistency, and the difference between growth and profitable growth. Question 13. How would you explain the difference between assets under management and assets under administration? Assets under management are assets for which an investment manager typically provides portfolio management or makes investment decisions. Assets under administration are broader. They may include record-keeping, custody, reporting, or plan administration services, even when another party manages the investments. Both can support revenue, but fee rates and economics differ. For a retirement platform, administration assets may generate servicing fees, while managed assets may generate investment fees. I would always confirm the company's specific definitions before comparing reported metrics. Be sure to define both measures, distinguish investment discretion from record-keeping or custody, explain fee implications, avoid treating them as interchangeable, and connect them to retirement and wealth platform economics. Question 14. Tell me about a time you found an error in financial analysis or reporting. In a monthly reporting file, I noticed that one business unit's expense variance was unusually favorable compared with its activity level. I traced the result to a duplicated reversal in an imported journal file, quantified the impact, and informed my manager before the report was finalized. We corrected the entry, documented the root cause, and added a duplicate check and review step to the process. The experience reinforced that unusual trends deserve investigation, even when they initially improve reported performance. Focus on the situation, how you identified the issue, materiality assessment, root cause analysis, communication, correction, control improvement, and the result. Demonstrate ownership without blaming colleagues. Question 15. Describe a time you had to meet a tight deadline with incomplete information. During a compressed reporting cycle, a key operational file arrived late and contained several missing fields. I separated confirmed information from estimates, prioritized the items affecting material balances, and documented each assumption. I communicated the limitations early, completed independent reasonableness checks, and scheduled a post-close update once the source data arrived. We met the deadline without presenting estimates as facts. The approach worked because it balanced speed with transparency, controlled discipline, and a clear plan to resolve uncertainty. In your answer, explain how you prioritized critical items, assessed assumptions, communicated limitations, created checkpoints, validated later data, and delivered a reliable result without sacrificing essential controls. Question 16. How would you investigate an unexpected variance in claims or benefits expense? I would first quantify the variance and determine whether it is isolated to a product, geography, cohort, or reporting period. Then I would split the movement into volume, mix, severity, timing, assumption, foreign exchange, and data effects. I would compare actual experience with expected claims, review large cases and reinsurance recoveries, and validate source data. After discussing findings with actuarial and business owners, I would document the explanation, assess whether assumptions need updating, and escalate material uncertainty. Make sure to cover materiality, period and product segmentation, actual versus expected analysis, volume and mix, assumption changes, data quality, reinsurance, seasonality, and escalation of unresolved issues. Question 17. What internal controls are especially important in an insurer? Important controls cover the full chain from policy data to reported results. I would expect input completeness checks, actuarial model governance, approved assumptions, independent valuation review, reconciliations, journal entry controls, investment pricing validation, access restrictions, and segregation of duties. Regulatory and capital reporting need documented review and evidence. Because insurers rely on large datasets and complex models, controls should address both automated processing and human judgment. Effective controls are preventative where possible and supported by clear exception escalation. Focus on data completeness, actuarial model governance, valuation controls, journal entries, reconciliations, access management, assumption approval, investment pricing, regulatory reporting, and segregation of duties across complex systems. Question 18. How would you explain a complex financial result to a non-finance stakeholder? I would start with the headline, quantify the impact, and explain the 2 or 3 business drivers without technical jargon. For example, instead of leading with discount rate movements, I might say that higher rates reduced the present value of future obligations but also lowered bond values. I would use a simple bridge or chart, distinguish temporary from recurring effects, and explain the decision implication. Finally, I would invite questions and confirm the stakeholder understands the conclusion and next steps. Be sure to mention audience awareness, plain language, a headline conclusion, business drivers, visuals or examples, quantified impact, implications, and confirmation that the stakeholder understands required actions. Question 19. What would you do if you disagreed with an actuarial or investment assumption? I would first understand the assumption's purpose, methodology, data, and approval history rather than challenge it prematurely. If concerns remained, I would present evidence, compare relevant experience, and quantify the effect through sensitivity analysis. I would discuss the issue with the owner and appropriate review committee, documenting both the rationale and alternatives. If the disagreement were material and unresolved, I would escalate through governance channels. The objective is not to win an argument, it is to produce supportable, transparent reporting. In your answer, emphasize evidence, respectful challenge, sensitivity analysis, documentation, governance, materiality, escalation, and the principle that assumptions should reflect supportable expectations rather than desired earnings. Question 20. What questions would you ask us at the end of a Great-West Lifeco interview? I would ask how success is measured during the first 6 and 12 months, which deliverables are most important, and how the team collaborates with actuarial, investment, technology, and business partners. I would also ask about current priorities, reporting or transformation initiatives, and opportunities to develop technical expertise. Finally, I would ask what distinguishes high performers at Great-West Lifeco. Those questions help me understand expectations while showing that I am thinking about contribution, learning, and long-term fit. Focus on thoughtful questions about success measures, team structure, current priorities, systems, professional development, cross-functional collaboration, and how the role contributes to policyholder, client, and shareholder outcomes. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.